told. Vikash Kumar Jain is joining us now. Vikash Kumar Jain is India strategist and head of India research at CLSA. Vikash, great to have you with us here. Thank you very much for your time. Appreciate it. Since you're on the program after a while, Vikash, as always, let's just get you a quick kind of context in terms of where you are in terms of your thinking. Because that evolves as the market has traded on, and it's done quite well despite all these geopolitical tensions, etc. The next one, I guess, we are going to focus back on trade with this tariff deadline. U.S. markets are less than 1% away from their highs. We're not very far away here either in India. What is your sense, Vikash?
Sure. Hi, Prashant. Thanks for having me. So, I think where we are today is the point where the first half has been very action-packed, very volatile, where market went from fear to ignoring the fears and all of that. I think now is the time when possibly things start settling down. From an India perspective, we had the good news of strong rate cuts, large rate cuts by RBI, and that has fueled some kind of an expectation. And there was also the period where there was worry around global trade, and that's something that worry as a corollary played well for India as a hiding place. Going into the next part of this year, the second half, there are a few things that we need to look through. Firstly, the tailwind that we had in terms of a surprise announcement on rate cuts and the extent of rate cuts kind of start go on a pause, at least, for a period. Because if you see now we're in a monsoon, the RBI has already said that it's put down its inflation forecast. And unless inflation is significantly lower than that, it would not really do anything incremental at this point of time. Plus, at the same point of time, the CRR cut will come into effect in due course. So the next RBI action is unlikely before the end of the year or so. So from a more domestic perspective, other than we signing a trade deal with the US and EU, which is, at least the US bit is now, has been talked about for such a long time that perhaps it should be in the price. Our domestic linked triggers would be rather limited. So I think from that perspective, whatever is happening globally is what will drive price action or on a bottom-up basis. And the problem that we've had on a bottom-up discussion has been earnings cut. In fact, we've come out of the report just today talking about earnings, where the problem has been that the kind of earning cut we've seen, for example, small caps as a universe has seen about 11% cut in earnings YTD. But the problem is where expectations are today. Of the NSE 500 stocks where there is enough coverage, more than half of the stocks expect earnings growth to be over 20% CAGR over the next 2 years. More than half, at a time when nominal GDP growth may struggle to be even 10%. So that, to me, is possibly quite optimistic expectations. So from a bottom-up perspective, my worry is that earnings cut might very well continue. So what we are seeing is not really any big, strong news flow to drive a massive rally in the market. So we might be in a range-bound market like we've been for the last 12 months or so. The market hasn't really moved up much on a 12-month basis. The other problem is around flows. Now, July, August, September last year was a pretty good period, the period after election results. And now in this quarter, when investors look at their performance sheets on a 12-month basis, they might start seeing negative numbers, even large cap investors. And that is where I think domestic flows, which have been coming off, could see some kind of an impact, because other asset classes that we as Indians have started doing very well, like gold and silver and some of those. In fact, even duration bonds did very well YTD. So equity, in fact, has been the worst performing large asset class, both for domestic investors as well as foreign investors, because India has also underperformed EM and world markets. But the problem has been that despite this underperformance, we are still expensive because of earnings cut. So, it's really a mishmash of these things, which means that we are likely to be at best in a range-bound market. And perhaps then we gradually derate to more palatable valuations.
So, a voice of caution, I dare say, I mean, maybe not bearish, but just realistic and cautious. We don't have too much of that in the market these days, Vikash. And, we picked that out from your note as well. You're citing, twin-pronged issues here. One is that earnings estimates are still elevated. And the second is what happens if the flows stop being as generous as they have been. And we've seen that. I ask that question to mutual fund CEOs all the time, that flows have become half of what they used to be. Let's just, play the devil's advocate. Let me do that on the other side. The other side of this debate, the narrative is that look at how generous the RBI has been. Then you have the income tax cuts and they'll start, making their way into people's hands. And then you get into the festive season where anyway India spends more and the monsoon has been bountiful. So all things put together, the macros should add up. The gods should come and smile on us in the second half and then things should pick up. That's the narrative of the bull camp. How do you counter it?
So, I'll say that we can see both camps in action in the market today. I think the part of the sell side earnings estimators are actually in that camp, whereas the ones who are talking about GDP growth, etc., are not in that camp. So I think one of those camps need to come right. If it is those estimates, which is half the companies delivering 20% EPS CAGR in the large NSE 500 universe, then perhaps that's the camp that you are talking about. Then, maybe today's estimates will be met. But the problem is that even on those estimates, we are also at very high valuation multiples. So with those estimates being met, maybe we will get reasonable returns on the market. My worry is that what if those estimates are cut? Plus we have a valuation worry. I think that might create a, reasonably underperforming kind of a market. So I would say that some of those, what you're saying is pretty much what is in earnings estimates today, but it may not be in the top-down GDP discussions yet. I think it's partly in the price.
Hi, Vikash. Taking the caution on board, maybe the earnings may not be as good as estimated, and maybe, bulk of the RBI bazooka is already in the price. That said, one clear tailwind for the economy as well as for markets is the way crude oil prices has corrected. What are you all working with in terms of crude oil prices? And how do you approach the beneficiaries, OMCs, paint companies, aviation companies? How do you approach them? Because for the OMCs, this is a big tailwind. We don't have state elections for the next few months. And valuation-wise as well, things are looking pretty okay. Your take?
So Trump's called this a 12-day war. I think crude prices have just gone back to where before the war started. So we're back to where we were at the start of this month. So it shouldn't be, that's what has exactly happened. We had a spike and we're back. And in fact, if you look at equity market action, honestly, it's also, kind of back to where it was. So I would say that that whole crude price thing is what has helped some of these companies from the start of the year to the correction that we saw till early July. Yes, there was a little bit of a crude price scare that we got, but that's now done and dusted. And I would say that since wearing my oil analyst hat, yes, OPEC has been trying to, OPEC says inventory to be pretty low, and that's why they're releasing crude price, more crude in the market. But the actual production has not kept track with their announced crude release. So unless they actually increase production like they have talked about in their plans, I think crude prices would be possibly in this range of $60 to $80 that we are in. And we are closer to that range of about 65, 67 today. So I would say that, yes, this kind of a benign crude price is something which helps India. And also that is the reason why inflation should be low. So I'm not really talking of any shocks for India. And I think this is something which should allow inflation to be very low. And so some of those beneficiaries should continue to see benefits, which not only the direct oil beneficiaries, but inflation being low means rates being benign. Even interest rate sensitives could kind of on a slightly longer period keep on seeing those benefits.
All right, Vikas, I think the call that you had made earlier this year was the FMCG staples. That would be the anti-consensus call. Holding on to that?
Yes, at this point of time, we've also added to one call just about 6-8 weeks back where we have gone overweight on IT. The logic for that is incrementally, like I discussed in my starting talk, was the triggers are likely to be more based out of foreign markets. That global trade is now settling down. Perhaps the US market is not looking that bad. And all of that will give confidence for IT companies in terms of the commentary that they give. And that commentary was the one big problem when they last reported results in April. I think with that commentary becoming a little bit more confident and their stocks have come off, valuations are not that extended like they were a few months ago. I think this becomes an interesting space in terms of amongst defensives. So what I'm trying to say is that, see, this is going to be a range-bound market, but incrementally, narratives are going to get more positive on the IT side. And that's where also one should start looking at it. See, there is a preference for defensive because I'm trying to more protect capital in a range-bound market, and that's where I'm overweight all the defensives effectively, IT, utilities, as well as FMCG or staples.
Yeah, Vikash, two questions. One, but IT as a sector has done quite well, right? Off the lows, in some cases, really well. So, I mean, it's going to now run into a better sort of new setup, as you're calling it. But will that mean stocks do well, or it's already in the price? That's one. And then you also like materials as a space, right? You think they'll earnings, etc., should be much stronger relative to their weight in the indices. So just talk to us about that as well.
Sure. So, we firstly on IT, see, I think there is a little bit of a dilemma that we are in because although some of these parameters that we discussed are not really looking, bullish, but our sentiment gauge suggests that sentiment is also neutral. It went to extreme bullish, extreme bearish early April, but it's kind of had a rally and now it's neutral. So all of that also means that there is no immediacy for the market to correct in any big way. So what might happen is market keeps chugging along, but that chugging along will be driven by international factors and international news flow. And that's where I think, IT will, where sentiment turned quite negative, would start seeing more positive action, possibly as we hear them in the upcoming result season. Materials, the other one that you brought out, we were actually quite overweight materials at the start of the year, but then we've taken some profit off. But what I see incrementally, and this is our note on earnings today, where materials is expected to be one sector to be a big contributor of earnings growth because both metals, cement, and some of the other places in materials are possibly going to come off on see EBITDA, unit EBITDA expansion, and also because there was some of it was depressed at the starting base, and that should possibly help. Maybe we will look at a better entry point to come back into that space, but clearly that is one space where incremental earnings growth, it looks like they will be punching above their weight in the benchmark.
Vikash, I just want to go back to that other risk factor of lower flows. So we discussed that on the DII side. I don't know what you're hearing from foreign clients because FI flows are absolutely patchy, right? Maybe they're also looking at the same concerns like you. I mean, that when earnings come back in a roaring way, maybe the money will come in as well. As of now, that's not happening. But then there's a huge supply side issue as well, right? These blocks happening on a daily basis. IPOs are also happening. Is that another risk? Are we anywhere close to an oversupply zone risk for the market?
Absolutely. So, I mean, let's talk about flows and let's talk about flows for the listed space because these are two different things. Because there is a big leakage in the middle, and that is really the supply side factors that you're talking about. Firstly, like we discussed, the domestic flows. Now, if you look at foreign flows, now, I have a firm belief, although we've seen this period of continuous inflows from domestic investors, my firm belief is investors everywhere are the same. They would want to invest in assets classes which will give them return, and that confidence on returns comes from performance. So performance gives confidence, and confidence is what drives flows. Now, if we look at performance for the last 12 months being patchy, that confidence is coming off, whereas confidence in precious metals and, even I would say certain urban clusters, the real estate prices, or even foreign markets, all of that is improving. So an expensive market like India, a foreign investor, when, looking at earnings being cut, markets being expensive, and the narrative not really being completely in India favor like it was in 2024, there is no desperation for them to add, money out of turn of foreign to India, which is the big fundamental change that we have seen. And that's where now that we have the TINA factor of India is getting challenged, they might look at investing in other markets as well. So there is no big desperation for them to put more and more money immediately into India. Everything that I say is not questioning the longer term story, but they might time it a little better. On the other hand, like you were saying, there is this big pipeline of IPOs, little bit of a jubilation by the market and things looking good. We see IPOs coming, blocks coming. And that's where all the flows might come in. They might not even reach the listed secondary markets, which is what we track in Nifty and others. It just might be going through IPOs and through these blocks, which means the secondary market has a bigger struggle for flows at this point of time.
So, Vikash, putting everything that you say together, you won't be surprised if fixed income as an asset does better than the Indian markets in the near term. Longer term, no debating, but 9 to 12 months, could that be a possibility?
Yeah, so in fact, I would say that that's what my belief has been. And in fact, that's what has happened for YTD and 12 months. I think it could continue. I would have been happier if this would have happened without much earnings cut, because that would have allowed multiples to become more palatable. But the problem is this has happened with earnings cut. So multiples stay extended and equity has underperformed. I think this could continue.
Okay, caution, caution, caution. And earnings. The moment those earnings come in, everything turns around, right? I think that's really what we're waiting for. Let's see. I mean, the stars have aligned in terms of the monetary and the fiscal aspects that we discussed. Maybe we do get a pickup. Thank you very much, Vikash, for joining in. Good perspective and good conversation. And we look forward to the next one as well.